let's get chatting with the management of Forgings. Vidyashankar Krishnan, who's the Vice Chairman and Managing Director of the company, joins in to detail their second quarter earnings. Remember, the company's volumes in the second quarter, or for the first half of this year, close to around 35,000 tons. The company is tracking to clock around 75 to 80,000 tons this year itself. Thanks a lot for joining in, sir. Can you give us a sense of realizations? What were the kind of realizations that you had in the second quarter? Was your EBITDA per ton maintained at the 34,000 mark? I mean, what's the outlook that you have from here?
Morning, Mangalam. Morning, Nigel. We are looking at about 34,000 rupees per ton, but approximately on an overall basis, because the EBITDA is a very complex number, we are looking at about 18 to 19% this quarter, this half year, and going ahead, look to maintain these levels with an upward bias because export overall freight rates are coming down globally. Hopefully, there will be some sanity in oil prices, and with all this, there should be it all should be positive for margins.
Okay. Hi. Good morning.
We're also riding on the back of strong growth.
So let's talk about growth then, Mr. Krishnan. Good morning. The street believes that you could be a re-rating candidate. So numbers and delivery is going to be most crucial. Give us a couple of numbers then. You said growth is going to be a focus area as well. So what kind of a revenue number are you looking to end FY23 with? Will it be in the vicinity of around 1,400 crores? And also earlier, I think in the following year, you were talking about hitting around 1,800 crores. Do you stick to that? If you could give us the revenue outlook as well as the volume trajectory. Go ahead.
Last year, we did about 62,000 tons of sales. This year, we would expect to end between 72 and 76,000 tons, closer to 75, and a revenue of around 1,400 crores on a consolidated basis.
Okay.
With the next year in FY24, we would look to cross 1,700, 1,800 crores, or at least reach those levels.
All right, that makes sense. You had a target of 2,000 crores coming in by FY25, so that ties in with the glide path that you have.
Generally looks to be on cards, Mangalam.
All right, and currently your functioning capacity is 130,000 tons, right? So this year you will end, you said 75,000 tons in terms of volume. So that would still be around a little over 50% in terms of utilization. By when do you get to that 100% utilization mark? Is that FY25 as well?
Yeah. Firstly, this 130,000 tons will be established only by end of the year.
Okay.
So we are right now at 120,000 tons. So on that, we would be about above 60% in terms of capacity utilization for this year. And at the end of the year, we expect to be at 130,000 tons on capacity. Effectively, the capacity will come in only into the next year.
Okay.
We would be expecting to achieve this close to this capacity, 110,000 tons plus by FY25 positively.
Okay. All right. So by FY25, we're looking at 110,000 tons in terms of the total sales volumes. In your industry, sir, just a question. Can you function at 100%? Since your capacity is going to 130,000, or are there some restrictions where you can only function at around 85 to 90%?
See, what we've also been doing consistently over understanding the nature of the industry and the cyclicity of our industry, we have factored that into our capacity. So I would say a capacity of 120,000 tons for Forgings is a distinct feasibility.
Right. A couple of other growth triggers for you. The first one was Cafoma, where you expected to cross that 100 crore mark in terms of revenues. Just wanted to understand by when do you do that and what happens to the margins out there as well. What is your target level? And the second one was off-highway, which is currently about 1%. You expected it to go to up to 5% of your overall contribution.
Cafoma has certainly brought in a lot of new business for Forgings. Per se, some backward integration into forgings and also forward integration into crankshafts. So Cafoma effectively has brought in a decent amount of business. By FY24, we should be knocking at between 75 to 100 crores as a result of Cafoma.
Okay. And
looking at the what was the other thing that you had?
Off-highway is what I want to
Off-highway, sorry. Taking off on the same theme, we currently run at about 6% on off-highway as it is. Because of the foray into the farm sector and also mining, etc., globally. So Forging stands at about 5 to 6% on the off-highway, as that's on target. We expect to clock around 7 to 8% by FY25.
FY25. All right. Okay. All right. What about the EV space, sir? The street was very excited. So give us numbers. That's what I'm looking forward to. How much are you going to invest in this EV vertical? And by when do revenues start coming? Is it a story of FY24 where we see some bit of revenue contribution? Or is it a story of FY25? Whichever year it is, what is the likely revenue contribution?
We are planning to invest a minimum of about 100 crores over the next 24 months in the EV space. This will take us to we're planning initially a capacity of about, say, 50,000 units. In FY24, we would expect to clock anywhere between 10 to 25 crores of revenue. And in FY25, between 50 and 100 crores of revenue on the EV segment.
50 and 100? 50
pushing
and 100.
ahead over there too.
Will it be profitable, sir? I mean, there would have to be a break-even point, right, for EV, or initially you'll be focusing on revenues and then gradually, that moves into profitability. Or from the word go itself, will it be, EBITDA positive?
I would say I'm a big believer in EBITDA positivity from the beginning, and this is the age and time where even 1,000 crore, 2,000 crore businesses do not make positive EBITDA,
yes,
and the street kinds of lauds their performance. So I don't subscribe to that view at all. So I believe with some amount of scale. At the same time, overheads need to be covered, and that will happen at some level of scale. So I would expect that from around 25 to 30 crore onwards, definitely we should be looking at EBITDA positive. And if you exclude development costs, I think we should be EBITDA positive from day one. Otherwise, there's just no point in doing the business. Money might as well be kept with shareholders and banks and safe away from organizations that burn it down.
Well, old world sage advice out there, no point being in businesses which don't make profits. So your shareholders will like that. Just a few things with regards to demand. I mean, you are targeting a fair amount of tonnage coming in this year and next year, etc. as well. But most of the global outlook is not particularly optimistic. There is signs of, slowdown, a lot of people using the word recession, grim situation. Do you see that from your clients' end as well? What can you sense in terms of demand?
Things are muted globally. 100% I would agree. It would be an undeniable fact. And Europe particularly is very, very sluggish. Having said that, if the conditions in Europe persist, particularly on the energy front, what will happen is supplies from European forgers to European customers will come down really sharp. And that poses an opportunity for Forgings. USA is expected to chug along, albeit with a downward or a stable trend as far as the economy is concerned. However, our big bet is on India. And last few years, we've been consistently saying that our domestic sales will zoom up to about 65% in the next few. And between now and FY25, that's where we are seeing a lot of action. And that's where a lot of investment is being focused on for the domestic market. So considering the tailwinds that we have in terms of development made in the last 24 months, 24 to 36 months, and which we're continuing to make and invest in the coming 24 months, I would say that broadly, these numbers should hold.
Okay, a couple of rules in finance that I learned early on, Mr. Krishnan. One is, if you're doing business, make it sure it's profitable. And the second factor is, debt is only a near-term friend. Later on, it becomes a bit of an enemy. For you, you're very comfortable right now. But given that you have capex, you have some various investments that you're looking to make, what is your current net debt for the consolidated entity? And where do you see net debt peaking out at?
Currently, net debt would be around 450, 500 crores. And we would expect that to be fairly constant over the next 24 months. Probably inch up a little to around 600, 650 crores and then claw back over time. So we are looking at these numbers are pretty stable, considering that this debt on a percentage of EBITDA is not a very significant number. We are well within managing limits, and our strength is that we have 2 years of repayments to cushion us through any kind of downturn, should it happen. But at the same time, we are quite positive that we should see positive numbers over the next 2 years.
Take that point, 450 to 500 crores the book on, debt on your books, and you're looking at it peaking out between 600, 650 crores, which would be pretty manageable given the EBITDA as well as the revenue guidance that you've given us. Thanks a lot, sir, for joining in and giving us your outlook on the business. Always a pleasure speaking with you. Wish you good luck for the remainder of this year, but more importantly, the next year and the year after that as well. With that, we'll simply